Bucket strategy. Alright, so here we have a fun one. I want to reference another video, so if you haven't watched it already, definitely watch it. If it's been a while, maybe double check what you're looking at here. But it's all about the distribution strategy is the premise for bucket strategy. So in distribution strategy, I'm just going to do a quick recap. Basically, we went over the sequence of returns, and we said in the sequence of returns, it's bad to take out money from a portfolio when it's down. And so if you have two different types of accounts, one that has stocks and bonds and mutual funds in it and takes risk and goes up and down with the market, and you have another type of account, maybe a growth annuity or something of that nature, that is a guarantee your money can't go down and gives you the upside potential of the index or the market. That can be really great for your portfolio because you can have two different types of accounts. So if the market crashes, you'll just pull money out of your growth annuity and it won't be down because that's how growth annuities work. It's always at the highest point it's ever been at. Even if the market crashes, you're still at the last dollar amount that you were at. And so in distribution strategy, I typically pair a stock portfolio with an annuity blend, and I do that based on their risk tolerance. So of course, if you haven't watched that risk tolerance video and figured out how conservative, moderate, or aggressive they are, you need to understand that. But let's just say it's 50-50. Okay, great, 50% in stocks in that portfolio and 50% in an annuity. That's how I sell half a portfolio worth of annuity to just about every client. Bucket strategy, I'm doing this for your guys' reference. It's not something that you'll have to do all of the time, but it is something that you will have to be aware of because this is how all other securities licensed financial advisors pitch this concept. It's not just with the two accounts in distribution strategy. Sometimes they'll do what's called bucket strategy, which is very similar, but just in the securities world. And here they typically use 3 or 4 buckets. So I'm just going to explain that. I want you to be aware of the concept and how it works so that when you're competing against it, you can make sure that you're doing a better job, or when you need to use it for clients that have $1 million or more, you can fit the annuity into one of these 3 or 4 buckets that you're going to create for the client. So same principle applies as the distribution strategy. You're not going to want to take out money when the account is down. Here all we're doing is layering different time periods worth of their assets. So here's a quick example. They've got $1 million. They say out of this portfolio they're going to need about $20,000 per year for the first 5 years, and then maybe $30,000 a year for the next 5 years. So just for your guys' rough math, that looks like $100,000 in the first 5 years and $150,000 in the second 5 years. And they might be going from age 65 to age 75 throughout the course of this. And that's, in addition to pulling out of these things, also collecting their pension, also collecting their Social Security, or whatever dollar amount I've determined for them to do this. Sometimes they won't know. In fact, most of the time they won't know how much they're going to need to pull off. You will need to be able to create the plan that says, okay, your pension's this much, Social Security is this much, that adds up to $3,000 a month, and you're telling me your expenses are going to be $4,000 a month or $3,500 a month, and that equals XYZ. And of XYZ per year extra that we need on top of these, plus a contingency or emergency fund, we're going to set aside the first 5 years in one bucket, the next 5 years in another bucket, and then a bucket for 10 more years out and a bucket for 10 more years out. And that way we've covered about 30 years or so of their retirement planning. You can, based on what your feelings are and your case design, of course you're not doing this in front of the client on the fly during your first appointment. You're always doing this off the phone when you have time to do research, when you have time to look at different carriers, look at different assets under management or securities products. You have time to research the annuities that you want to put in this type of planning. But basically you are saying in bucket 1, the first 1 to 5 years, this is going to be our most conservative bucket. It is not going to have very much highs or lows at all. It's barely going to go up. It's barely going to go down if the market crashes. You're not going to see much movement at all. In fact, most of this portfolio is made up of things like the money market, getting you 1% or maybe even less on an interest rate basis. That's okay. That's all we want for bucket 1. And again, of their $1 million portfolio, maybe we're only putting $100,000 in here, but we've said for the next 5 years, they probably aren't going to need this other $900,000, which allows us to say, okay, in the second 5-year bucket, maybe I'm putting into a 5-year annuity. So the second and the third bucket usually are used for these growth annuities. So let's pretend for a second I've got, I'm not going to name the carrier because I'll work with you individually and specifically on that. So, but we'll just call it a great annuity company, and it's a 5-year product. Okay, so it says after 5 years it becomes fully liquid. The second year through the 5th year you can only take out 5 or 10% or something, but after that 5th year you can take out as much as you want to. So here it's a 5-year product, and it says, you know, if the market crashes, goes down even a penny, you're not going to lose a penny, which is terrific to know. So we have that safety. This is also okay in the securities world for other financial advisors to use maybe a moderately conservative portfolio. It takes on a little bit more risk than the conservative portfolio in the first bucket. So bucket 2 can take on potentially a little bit more risk, or in the scenario that I like to use of the growth annuity, no risk, absolutely none. You know, we've got a guarantee, we can't lose money, love that, and we're going to get some market participation. So if the market's up 20 or 30% like it has been for a couple of years now, 2019 was terrific, 2020 was terrific, 2021 is also ending terrifically here at the end of the year. So I want you guys to understand that in this area where we can take on a little bit more risk, even a third of that, you know, 20%, 30%, or I've seen carriers as high as 50 or 60% of what the market does or what the S&P 500 does, are really great rates of return. When we're looking at, you know, 2019, 20, and 21, we're all, you know, 20% plus. If we're getting these guys a third of that, or 7 to 10% of that 20 or 30% up, we're doing a lot of good for the client. And that 7 to 10%, of course, that they're getting on the gains on the upside here are totally risk-free. If the market went down that 20 or 30%, they wouldn't have lost a penny. So having those 7 to 10% here in this maybe 5-year bucket is terrific rates of return as compared to the very conservative portfolio. I typically do not put annuities in this first bucket of money in the bucket strategy because it needs to be fully liquid. They are going to deplete the first year. They are going to deplete the second year. Even if I have good growth on the other buckets, which I'll explain here in a second, we funnel the growth of those into the other buckets. Even if I funnel bucket 4 into 3 and 3 into 2 and 2 into 1 here, we are at least going to use those first 2 years in that very first bucket. So for that, I usually make it up of money markets or securities products with an ultra conservative risk tolerance. I mean, when we're talking about drawdown, I'd like a drawdown of 3 or maybe 5% of the overall portfolio if the market were to crash completely. I don't want any more risk than that involved in those portfolios. So I will note here, a lot of the competition that you will face in the security side, all they can sell on their safety side is money markets inside their own portfolios. Typically, I've seen their yields at 0.01% or 1/100%. And, you know, at Jones or Merrill Lynch, these guys are probably charging 1.5%. So the client net is losing 1.49% when they're in stuff like money markets inside of there. The other safe money is bonds. And how I explain this to the client typically is that bonds do well when interest rates come down. And so they used to be a great haven for the stock market because you can put stocks and bonds in a portfolio, and the safer you want it, the more you load it up with bonds. Though if the market crashes, you got a little itty bitty bit in the stocks, but you have a large amount in bonds. That way when the market crashes, your bond portfolio is safe and it's doing okay. That worked out well when interest rates would come down and bonds would do okay. They'd get 2, 3, 4% for the most part, and they'd be your safe investment. This is still what I see today in 2021 and what I'll see here coming up in 2022 for the Ed Jones portfolios, the Merrill Lynch's, the Morgan Stanley's of the world. This is still what they're putting safe money in. And most of the portfolios that I analyze and see from these companies, they're down 4%, they're down 5%, because what's happening in 2021 and will likely happen in 2022 and for at least the next few years here is the Fed announced they are going to raise interest rates to keep inflation in line. And because of that, bonds are going to continue to slide. They're not going to do well. They're not going to be as safe as they used to be. And if interest rates keep going up, I see bonds continuing to slide. And because I see that, and because that's been noted by the Federal Reserve and all of the important economists that are following this sort of stuff, it's really important that we don't put clients in bond portfolios that are not safe. And so with that being said, I'd prefer these money market type of accounts in that very first bucket. So second bucket here, I'm getting back to the growth annuity. What you really care about is selling. So maybe in the second bucket, a 5-year. If you want to transition that second bucket and say that second bucket is not years 5 through 10, maybe that second bucket is years 7 through 14 or years 10 through 20. If they're not needing much money in the first 10 years, you can say, okay, the second bucket is 10 years out, and now you can create that second bucket as a longer term annuity, like 10 years or that sort of stuff. You can do that. You can also just make sure that the client has enough liquidity, and what I mean by that is if they're going to take out 10% or less of their portfolio, if they've got $1 million and they only need 20,000 or 30,000, that's only 3% of their portfolio. So knowing that I'm staying within the 10% free withdrawal of most of these annuities, I'd still be staying in the 5% free withdrawal if I put all of their money in the second bucket. Still wouldn't recommend doing that, but if I wanted to, I could, because I'd have the liquidity needs of the client covered, and that's going to be suitable and appropriate for him. So second bucket, I usually use that 5 to 10 year, and I use a growth annuity. Third bucket, I'll also typically use an annuity, because why take risk if we don't have to, on these 10-year annuity, or maybe even 14-year, depending on the product and stuff that you want to work with and how long of a time horizon you want to put in place here. This third bucket is a great area to have some of those longer term annuities, and inside those we can typically get, when we're talking about 10 years instead of just 5 years on a growth annuity, we can typically get better rates of return, better participation rates on underlying indexes, better cap rates. Sometimes these 10 and 14 years have much higher bonuses and much better performance. So I like to use those if at all possible here in this third bucket. Maybe we're talking with someone too young though, and they have too aggressive of a risk tolerance, and we can only put money a little bit into growth annuities in the second and third bucket, and then some of that, and definitely usually for the fourth bucket, that they're probably not going to touch for, if I use bucket 1 for 5 years, bucket 2 for 5 years, and bucket 3, the 10-year annuity, and I put enough money in there to satisfy years 10 through 20. This last bucket has a 20-year plus time horizon. And when you're working with people with $1 million, this works out phenomenally, having these 3 or 4 buckets. Sometimes you need less buckets, sometimes you need more. Sometimes you want to vary the duration of these buckets. So all of this is manipulatable. You're able to edit these, you're able to come up with the best plan for the client. I'm just giving you general examples here. So this fourth bucket, because it has a 20-year plus time horizon, I typically don't even use annuities. I want to get the client much higher rates of return, and I want to put enough money in there that this fourth bucket is really, 20 years from now, it could replace all of the monies in bucket 1, 2, and 3. So kind of with that in the case, if I'm putting 100,000 in bucket 1, 150,000 in bucket 2, and maybe 250,000 in bucket 3. Now I've sold 400,000 worth of annuities in the middle here. And then on the end, on that fourth bucket, when we're talking about the remainder, that's $500,000. Well, $500,000 in growth stocks or securities. Again, if you're unlicensed, you can't sell it, but if you work with someone like me, I can sell that for you, and we can work together on the middle pieces here. That fourth one, that $500,000, 500,000 over 20 years, as long as we're ending on a good year, we're definitely going to be more than $1 million. So, especially if the client is only taking out $20,000 or $30,000 a year, we might be at $1.5 million or $2 million based on 20 20-year growth, depending on the interest rate we're getting. But if we're getting things like 20 and 30% rates of return on growth stocks in good years, in that long-term fourth bucket, we're going to do a lot of good. So this is typically what you'll see the financial advisors or guys that are only licensed in securities sell, is maybe, and I'm just going to use asset allocation percentages here. So for bucket 1, they might be 20% in equities, and then bucket 2, 40, bucket 3, 60, and bucket 4, 80% in equities. And the remainder of all of that is usually heavily weighted in bonds and very little in money market. And again, the clients that I see are typically losing money via the fee and the money market, or losing money on the fee and the negative maybe 4% or so that I'm seeing on these bond portfolios. So if you don't do what I just did and pitch all of these 4 different buckets and say, this is a better plan because bucket 1 is going to take on less risk, bucket 2 and 3, absolutely no risk, so you're taking on much less risk, and then bucket 4, I can probably get you higher rates of return in these growth annuities. So in the first 3 buckets, I'm getting you higher rates of return or the same rates of return. Bucket 4, I can get you a little bit higher rate of return. I'm getting rid of a lot of the fees. Typically, I sell the growth annuities with no fee or very low fee that is comparable or less than their current advisor. So it's really easy to pitch that. If you didn't want to do this 4-bucket approach and you wanted to simply say maybe they have less retirement dollars, maybe you are just looking at a quick, easy sale here. Maybe say they've got $100 grand and they've already got their 3 buckets divvied up, and you just want to pitch against that. Even though it's not the worst thing in the world for the client, you wanted to give them another option here. I can say, okay, 40% of your portfolio is in bonds of this 100 grand. Maybe they don't even have these buckets. Maybe that wasn't introduced to them ever, and that's common in our world, is we don't have financial advisors doing enough education with the clients. And so maybe I just look at their portfolio. They've just had one portfolio for 20 years, never really worked with anyone. They got an Ed Jones account, but they don't have an Ed Jones guy. Stuff like that situation. They got 100 grand. They don't actually plan on touching any of this money. Their income fulfills their expenses in retirement in perpetuity. This is just kind of backup money, or money going to the kids eventually. They haven't quite figured out what they want to do with this money, but the risk tolerance says 60% of this should be in equities. So how I compete against that in those situations is very simple. I say, okay, rather than this long extended bucket strategy, which is going to get you a sale large majority of the time if you do that long-winded bucket strategy and present it in the case of, here I'm comparing what you have to what I'm proposing, these are the pros, these are the cons, and going through that whole scenario. If you just say, okay, 60% of this portfolio is in stocks, 40% is in bonds with Ed Jones. On the bonds, you lost 4%, and they're charging you 1.5% to manage it. So you're losing 5.5 net on this 40,000 or 40% of your portfolio here. I've got an alternative for you. There is a no-fee growth annuity. And inside that no fee is, we have a guarantee you can't lose money, so technically it's safer than bonds, and we tie it to things like the S&P 500, or then you name a proprietary index from that company. So whether it's the Credit Suisse or the Barclays or the BAML or the Zebra or the Twisty Loop, whatever. We've got all of these different companies coming out with their own proprietary indexes. You name the S&P 500 and that one that you're potentially going to recommend here, and say, well, the S&P did 30% last year. At 1/3 of that, you would have done 10%. Here's the chart. This is an illustration. Here are the numbers behind that. You would have gotten 7%. You would have gotten 10%. You would have gotten whatever. And then say, compare that to net. You lost 5.5% on your safe money. Here, keep your equities. You know, if you don't sell these, you can just keep your equities. Tell them you want the 40% that's in bonds to switch over because you believe these are going to be safer assets. Safer assets, of course, are going to be that growth annuity. So, and of course, inside that growth annuity, have a guarantee they can't lose money, so it is safer, and it can potentially give them higher rates of return if the S&P or the Credit Suisse or whatever proprietary index does better than what they have. So that's it for bucket strategy. That's what it is. That's how to compete against it. I don't think there's too much else that's really important for you guys to understand, except that when we are going through this, it's really important for the client to understand they have all of these different products, all of these different companies, you've labeled them, you've done all of that. They don't even need to remember any of this. You're going to manage it and watch over it for them. When they want to check, you're going to bucket one first. So if they need to remember something from this conversation, it is the priority order in which of those buckets they're going to be drawing from and when. So bucket one is the first one, bucket two is the second one. Now within this bucket strategy of all of the things that I just mentioned, I will add in one more thing. Now we need to take into account tax strategy. So tax strategy is the thinking of which money should we use first, and it doesn't have anything to do with buckets. It has to do with, is this money non-qualified, and as it grows adding to their taxable liability for the current tax year, or is it in an IRA, and as we pull money out of it, we're going to need to pay the taxes on it. So maybe if we just turned 64 and we worked 3/4 of the year, and next year we're going to be making less because we're on Social Security, the IRA or 401k is not the first place that we look. We look either to the non-qualified or the Roth money. And the Roth money, you can kind of make those determinations, but it is not adding to the current year taxable liability. So now we need to take into account all of their different kinds of accounts, which is really important that we get all of this information on the fact finder. So when I'm going through that fact finder, make sure that you're asking what company is it with, what's the tax wrapper around it, and if they don't understand that, give them examples. So is it a 401k? Is it an IRA? Where did this money originate from? Was it an inheritance? Did they pay taxes on it? Are you going to have to pay taxes on it? Have you taken distributions out of it? Have you been forced to take distributions out of it? So you ask all of these questions and figure out the tax wrapper around these, and then get the value of those, of course, so that we know where to map them into. And so now we can say, okay, we have all of this qualified and non-qualified monies, both pre-tax, post-tax, after-tax. How are we going to fill each of these buckets with that tax strategy? And so again, you're not doing this on the fly with the client. This is a little bit more complex. You are going to want to sit down and do this case design off the phone when you have a minute to think, and you can really put a good plan in place for these folks. So that is the second condition to the bucket strategy, and that is important for you guys to remember. And so that's all I have for bucket strategy. Hopefully now you guys understand how to compete against it, how to use it in your own practice for at least bucket 2 and probably bucket 3 as well. Even if we need to, in lieu of using money market, we can even use their savings account at their bank, just move it and yearly tell us how much you're putting from savings into checking here, because the interest rate isn't going to matter very much. You don't need a securities license if you tell them to put this money in their savings account rather than a money market. The interest rate is going to be, negligible if we're talking about low dollar amounts anyway here, so that's not going to factor in very much, but that way it gives you the opportunity to sell that second and third bucket. Maybe they don't have enough money to even have money in that fourth bucket, or maybe they don't have high enough of a risk tolerance to have any money in that fourth bucket, and so you're able to position their money as, here's some in your savings account, and then we got a large amount, years 1 through 3 or 1 through 5 are in their savings account. Years 5 through 15 are in this shorter term annuity. Years 15 out are in this third bucket in this type of an annuity, and you can structure them like that as well. So a lot of different ways to structure those, but knowing the rates of return that you get for the longer time horizon that you go is important for the client to understand on these type of annuities. That's why you'll probably recommend different companies, probably recommend different products within the same company or multiple companies. That's the reason for that, is because you're shopping around, you're figuring out the best deal for them, and then you're coming back to the table and giving recommendations. I do like to mention to all my clients that, as a comprehensive financial advisor, I'm not just gonna, I don't just work for Ed Jones. I'm not just gonna sell you American funds. I have the ability to work with lots of different investment companies, lots of different products within those investment companies, and because of that, I want to do the due diligence and time and research to find the best companies for you and your situation and put together the best plan that I possibly can for you. When you phrase it like that, they really understand and appreciate what you're doing. You're building up more rapport and trust with them. That way when you're coming back on the next appointment, you're able to go through that. So that's all for bucket strategy. Thanks for watching. Have a great day.